Okay, thank you very much, everybody, for coming. Good evening. We are expecting a couple of other people, but I think we need to get going. It's wonderful to have you all here. Last function was March last year, so it's been a while. And we didn't have one at the end of last year, so this is like the replacement. And hopefully we'll have one at the end of the year. So, and we're getting back to more of a normal kind of routine after COVID, which certainly threw its curveballs, as did last year. So just to give you a heads up as to what we're doing, Mike is going to talk first. This is Michael, our very trusty Chief Investment Officer, and he's going to give a run through of the markets and some of what happened last year. I think it's very good, so I'm sure you will too, but it's quite difficult to see. So Michael tells me he's just going to make up something on the slides that you can't see. So you can put them out if it doesn't look like what it looks like on the screen. And then I'm going to say a few words, and then Andrew Lawson, who I call Og. So I might try to say Andrew, but I don't always remember. So in the office, we know him as Og, say the same person. He's going to do a few words, and then after that, we will have snacks and more drinks. And I hope you've got something to get you through what will be 45 minutes to 45 minutes. We'll keep it at 45 minutes. Okay, here's handing over to Mike, our Chief Investment Officer.
Great, Di. Thanks very much. I must say it's great to be back with you all again, and with COVID having been in our most recent memory. I must say, being here at the Joburg Country Club, one of my biggest memories of the event we did here was when we were all like stunned mullets when Oggs was busy trying to explain how blockchain and what have you worked. And I have to admit that I'm still completely clueless about that. So I'm going to take you through the investment story. I'm very glad that we're doing it now. I think had we done it in November last year, you probably would have wanted to take me out and stone me in the car park. So I'm glad to say that the story is looking a lot better. And I think that's an important message to appreciate up front.
Joking.
Doesn't work. Okay, we'll put that aside. Okay. All right, fantastic. I'm going to try and zip through this as quickly as I can, because I know we've got, what are we talking, 45 minutes to an hour standing between all of you and drinks and snacks. So what I'm going to just take you through is to reflect on 2022. I don't have to tell you it was a difficult year. You were all seeing your statements and chewing your fingernails off. But never let a crisis go to waste. And I want to talk a bit about how we've changed and how we've grown up and how we've improved as a result of what we went through. Okay. All right. Okay, fantastic. Sorry, we do have our online audience as well. So this is, from a technology perspective, quite a big advancement, and what could possibly go wrong? So anyway, so this is one of those complicated slides, and I think it just puts 2022 in perspective in terms of what a tough year it was for all asset classes. Really it was a year where there was almost nowhere to hide. And essentially what this is showing you is just how much of an outlier it was from a performance perspective, whether you were hiding in the supposed safety of fixed income or in equities. It certainly wasn't the worst year we've had for shares. But when you add it together with what all the other asset classes did, I think it's a year that most of us would gladly like to forget, and thank God it is behind us. So a terrible year. There's no other way to describe it. And what was the major cause of that? In retrospect, it was frankly the fact, what kicked it off was that inflation turned out to be far, far worse and far stickier than we had anticipated the world had anticipated going into 2022. There are three of the major causes that, frankly, at the beginning of the year, we didn't really see coming. So it was the sort of massive demand from all of that pent-up cash that people had coming out of COVID. Then, of course, Vladimir Putin decided to upset the apple cart when he invaded Ukraine, and that turned commodity prices on their heads. Gas, oil prices, all of that went through the roof, adding further fuel to the fire, so to speak. And then China went and blew its own feet off in terms of the way they chose to handle COVID. and essentially caused all of these supply chain issues. So inflation was the big issue we faced, if there was one thing to talk to. And as a result, we saw interest rates being pushed up far higher and far faster than any of us had anticipated, something that markets were really not prepared for. So the red line there that you can see is just showing relative to previous interest rate hiking cycles, how sharp it was and how big the change was. And, we all saw the consequences of that in terms of what happened to the valuations in equity markets and the disruption that's caused. And to be honest, we're still seeing the reverberations of that with some issues in the banking sector, for example, more recently. But, I think what one has to appreciate is just how much pain we absorbed last year. It was, all of us, it was an extremely unpleasant year. Now, let's look at our performance in context of that. Now, what I've done is just shown the performance of our funds, because whether you're invested in local equities or in offshore equities, your portfolios will have largely replicated what these funds have done. So, okay, no problem. As I say, what could possibly go wrong? So on the local front, frankly, and one of the things I'm going to talk to is, as we look forward now, not to become complacent by how well local equities held up last year. I'm really focusing on 2022 here, but our local equity fund actually ended up in positive territory, and that was very much in line, maybe a little better than what the market did. And the South African equity market was one of the few markets in the world that actually landed up in positive territory last year. Now, I think if I was to point to two things that caused that, it was probably the fact that we went into the turmoil of last year with the valuations for South African equities actually quite low. So, set the bar low. There's not really too much concern about where you go from there. But the other thing is that through no sort of great grace on our part, South Africa just found itself in a very fortunate position that as a commodity producer, we were very well placed for what Mr. Putin wreaked on the world last year. So, frankly, we saw commodity prices rally and our equity market benefited from that. But as I say, we'll get a little bit more to discussing how we see South African equities just now. Not a bad place to have been last year. If we look at our offshore equity fund, this is obviously our flagship, and certainly in terms of our approach to investing over the long term, our mantra for a long time has been, live in the sun, invest in the shade. And for a number of years, that worked really well for us. We delivered solid, double-digit teen, up to 20% returns. And in 2022, we experienced tremendous pain. And frankly, a lot more severe pain than what we saw in the market. And for us, that has caused a huge amount of self-reflection in terms of what could we have done differently? Is the strategy that we've followed been the correct one? Do we need to change anything? And I think that's an important issue, to be humble about these things and make sure that we learn from the experiences we go through. And certainly as we go through this presentation, I hope you'll appreciate that we have taken a lot of lessons from what we experienced last year. And I'll share some of those with you. So, first of all, why was the performance that you experienced relative to what was a difficult market so challenging? I think the first thing was more from a market perspective. As I said earlier on, there were very few places in the green last year at all. And unfortunately, where those were are not really the areas in which our investment approach typically invests. As we've said to you over many years, we follow very much a quality investment style, and areas like energy, high capital intensive industrial companies, those are not typically the areas in which we invest. And as a result, unfortunately, in 2022, a lot of our, can I call it, hitting zones are very much at the bottom area of this particular slide in terms of the sectors that we have tended to invest in. And obviously that caused us to reflect on why is it that we had, missed such a big drawdown. And we'll get to that a little bit more in due course. But what are some of the lessons, if we could go back knowing what we know now, what might we have done differently? And this, I hope, will sort of make clear to you that we have learned some very valuable lessons. We are doing things differently now. Unfortunately, the way it is with equity markets, there's never an end to the lessons we learn. So no doubt there will be issues that arise in future. But I think we've certainly come out of this downturn, if I can say it, better for it. So first of all, in retrospect, we had too much exposure to emerging markets. We really did buy into the sort of structural growth story of China and all the good stuff that people spoke about. And frankly, what did happen in China, they appeared to be in complete self-destruct mode, first of all, by declaring war on their technology sector. And then, frankly, by the way that they handled COVID, and then throw in also the issues that we faced with the geopolitics between the US and China. So, we took a lot of pain there. And currently, the positions we hold in emerging markets generally are considerably smaller and will, in all likelihood, remain so going forward. The other thing is that as much as we very strongly believe in quality in terms of the shares we select, in retrospect, I don't think that we appreciated how expensive those kind of shares had become, even in the context of an expensive market. And I'll show you something on that in due course. The next thing, I think we got sucked in by the nonsense that a lot of investors were drawn in by around COVID. A lot of the things that people were talking about as, a permanent change in consumer behavior, for example, have turned out to be a lot more cyclical. To be honest, as time has gone by, I think life has returned more to the way it was before, perhaps, than some of the great visionaries believed it would. And I wouldn't say it was extreme, but I think that some of the investments that we became very excited by turned out to be more cyclical than we would have liked. And then, if I'm honest, I think what I've called, we became a bit too growthy. And maybe that was a consequence of what was doing well through COVID. We are only human. And we probably invested in companies that will, in due course, I think, be great success stories, but a little bit too early, frankly, if I'm honest. And then finally, we did add some smaller shares that we think are great quality shares, and we're very excited about them. But in truth, when markets go down, investors tend to gravitate towards the Apples and the big known names. And we took a bit of pain there. So as I say, we certainly learned a few lessons through that. Many of the shares we're still holding, and we're still very excited by them. But as I say, these are, if I'm going to stand here and give you a bit of a confessional, those are some of the things I think we got wrong. Now, I'm just going to take you briefly through our thoughts on a couple of the asset classes as we stand today. So just starting with South African equity. So as I mentioned earlier on, last year, in relative terms at least, against a very low bar, South African equities did quite well. And the question is, where to from here? The first thing I would say is, the bulls will definitely tell you South African equities are cheap. And what we're showing here is just the valuation from a perspective of, what is the price you're paying as a multiple of earnings expected in 12 months' time. And you can see on what we call a forward PE of about 10 times relative to history, they are actually looking very cheap. There's no, certainly relative to their own history, there's no denying that optically South African equities are looking good value. The question, well, I should say are looking cheap, but the question I pose to you is, does that necessarily translate into good value? I'm just going to take you through a few sort of broader perspectives on SA equities that, without being too much of a spoiler here, I think cause us to believe that cheap they may be, but in terms of long-term investing, it's still not a market that we're particularly excited by. So this first slide here just shows you what's happened to the number of listed companies in South Africa over the last 20 years or so. So, the period that preceded this particular chart, I think it was pretty much, real frontier time after the 1994 elections. We saw lots of new companies listed on the JSE. And then, there was a bit of a clean out in the early 2000s. So, we saw a lot of companies delisting. But I think what particularly concerns me is that post-2008, you've seen a really consistent sort of stream of delistings. And over this period, the number of listed companies in South Africa have actually more than halved. And that really concerns us, because what you want to see in any sort of healthy market is a steady refresh of companies arriving, new opportunities in all, in terms of what we would really like is new companies that give us better exposure to some of the growth areas of today. And, we feel that much like, say, the UK market, South Africa is quite a stale market today. It doesn't give you exposure to some of the exciting kind of frontier growth opportunities in the world. And we'll talk to that in a little bit more detail just now. The next issue, this is probably one of those slides that I will say is hard for everyone to read. It's really talking about the degree of concentration of our market. First of all, in very cyclical commodities, and then in one company, which is essentially NASPERS. We've shown it here as sectors, but technology services is effectively NASPERS. And the issue is if you add together the impact of NASPERS on our market and the miners and the likes of Sasol and what have you, the two of them together, those areas, account for, through most of time, 50% or more of our market. And the question really is whether one wants to be that exposed to those particular asset classes. And why do we say that? Sorry, this looks like I vomited on the slide here. So I think we could have probably chosen some better colors. But let me try and explain to you what I was trying to show here. Essentially, what I've done here is shown how a selection of companies have performed from a total return perspective. In other words, if you add your dividends and capital appreciation together, what sort of performance have you got? And the blue lines there are a range of South African mining companies. I haven't really tried to, sometimes when you do these charts, you can try and make sure you get the right answer up front by selecting companies accordingly. I just wanted to make sure that I got a good cross-section of companies. Then all those ugly golden, yellow, and red ones, those are sort of the rest of the SA market. I've got a bank in there, I've got a luxury goods company, a retailer. And really what I'm trying to highlight is that, with these mining companies that dominate our market, if you get the cycle right, you can make a lot of money out of them. But if you look at them over the long term, they've actually been pretty poor performers. And if you're thinking in terms of the way we try to approach the market, which is to identify those compounders over the long term, that's not really the area that we typically find the kind of shares we want to invest in for the long term. And unfortunately, they really do dominate our market. And we tend to think of mining shares as the type of shares you date at the right point in the cycle. You don't want to actually marry them for the long term. Another thing just to think about South Africa, this is probably something in the past you would have seen as a virtue. I just question whether it's the same today as perhaps we used to think about it, is just the degree to which the largest companies in South Africa are almost hostage to China. As I say, if I was to have done this presentation probably 4 or 5 years ago, I would have said that's a great thing. I'm not so sure about that today. So, 60% of our market in 20 shares, of which the majority are really for reasons of commodity exposure, NASPERS' investment, luxury goods, play on China. Just something that you really perhaps want to question whether you want that degree of concentration in the South African market. Is that really what you expected you were getting? And then, I think this brings things closer to home. If you look at, and what I've tried to do here is just sort of smooth out what's happened to South African economic growth. And you can see in the early 2000s, we had the commodities boom at the time. South Africa was really humming. And then around the time of the global financial crisis, that was the beginning of the Zuma years. And you see how we have stepped down in terms of growth for all the reasons that I'm sure you're reading about and have followed in the press over the years. And unfortunately, that sort of trend downwards in growth has continued. Now we're dealing with load shedding and what have you. I don't want to dwell on that too much, but the problem really is that certainly the outlook for growth in South Africa relative to what we've experienced in years gone by is just not that exciting. And unfortunately, try as they must, I think it's very difficult for many of the companies in South Africa to escape this. So in terms of how you want to be positioning your investments, this is important to keep in mind that we've seen this diminishing growth story. And then finally, I made the point earlier about our market being stale. This chart is more about showing these long waves of innovation and the degree to which the time of these waves has really shrunk, and essentially that innovation in the world is speeding up. But what I was particularly struck by also is how our particular listed universe doesn't position us terribly well for things that are really at the leading edge of innovation today. IoT, AI, You could say maybe that the green energy revolution, we can benefit through resources. But I just question whether you're going to get the exposure to true growth and dynamism in the South African market that you can get elsewhere in the world. And then just changing gears a little bit, just wanted to comment briefly on the Rand before we look at offshore markets. This is our trusty purchasing power parity model that Anchor has used in terms of giving a sense, and it sometimes feels a bit of a futile exercise trying to call where the Rand's going over time. And, what our Rand expert has highlighted is how at times when there's been a major kind of, call it South Africa specific event, be it sort of self-engineered or whatever the case may be, those are times you've seen the Rand really blow out to extreme levels. Then it has tended to drift back to, somewhere around purchasing power parity. I think the key message to take from this chart is after the sell-off we've seen in the Rand, it does certainly look at the moment like it's a little bit oversold. However, I like this particular chart, which is certainly, to my mind, showing a pretty good fit, giving you the relationship between what the Rand-dollar exchange rate has done and the level of load shedding. So as we head into winter and the scary things that we're certainly hearing about load shedding, certainly I'm not a bull that we're about to see an imminent recovery in the Rand. But I do acknowledge that it is probably sort of in terms of that longer term cycle, a little bit oversold.
Don't worry.
As we change gears now and start to look at the international market, I made the point up front that you need to appreciate just how much we have absorbed over certainly the course of 2022. Okay, we're almost there. I'm pushing through here, Dai. So, obviously, big factor that hurt us last year was the rise in interest rates. Are we at the top yet? I'm not sure, but it certainly feels like we are very close to it. If we see another hike or so, most of the pain is behind us. And, as we see rates begin to roll over, generally that is expected to be supportive for international equities. So that's the one point. The other thing, at the end of the day, over the longer term, what drives share price performance? It's earnings growth. And, as much as people are concerned at the moment about a recession, it's expected to be a mild recession ahead of us. So I think it's also important to appreciate that by the end of this year, we're probably going to have seen 3 years, if you strip out the impact that energy had last year, of pretty lackluster growth. All of those supply chain issues, inflation that companies had to absorb. We've got quite a lot of pent-up performance, I believe, in companies from an earnings perspective. And you can see into 2024, as things stand at the moment, how there's quite a strong expected earnings recovery ahead of us. And ultimately, that's the sort of thing you've got to look to. I made the point that our style of investing, we underappreciated in retrospect that those shares got very expensive. So what this chart is showing you is the premium that those types of companies, the typical companies you'll see in your portfolio, yes, they always tend to be more expensive than the broader market because essentially you're paying for that. It's just a question of how much more. In retrospect, they got too much of a good thing. They became very expensive. And through the course of 2022, we saw that completely unwind. And that was a lot of the reason that our portfolios underperformed. But what's really interesting now is that we're back in territory, quite frankly, where relative to history, they're in relatively cheap territory. The fundamentals of these companies haven't changed very much, but that expensiveness, if I can call it that, has largely disappeared. And are we going to see a recession? It's possible. I think certainly the majority of people do anticipate that that is what lies ahead of us. But considering, how we've adjusted portfolios, I just wanted to highlight the kind of strength of the typical shares in your portfolios versus the broader market. The returns on equity that they generate on their capital are superior. Their debt is relatively low. Their margins are higher. And yes, they're at a premium, but these are the businesses that are going to survive and prosper through a downturn, and we will come out the other side of it. So as I say, we feel pretty comfortable that we've learned lessons from the downturn. We've implemented those in portfolios, and we're ready to weather that downturn. I almost wish it would come because it's feels like one of those things we need to get behind us so that we can get back to business of making money. Quick word on fixed income. We've been through a long period when there was zero yield out there. One of the things that has happened is there are actually quite decent returns available. This chart shows you from the extreme left what you can get for taking almost no risk out there, almost 5% in the US. And as you go towards the right, you're looking at returns for types of debt instruments that look more and more like equities. But no denying, there's some quite attractive opportunities in fixed income. I think our heart still lies very much in equities for the long term, particularly on an after-tax basis. We still think that in the long term is where you're going to get your returns from. So just to sum up, I'm almost there, Di, I promise. So I call it quality investing 2.0. We have learned some lessons. We've taken them on board. I think we've diversified the portfolios nicely. We've reduced that emerging markets exposure. And we think we are very well prepared to weather whatever may be thrown at us. And again, just to stress that we think a lot has already been thrown at us. Beginning of this year, there was almost a universal expectation of a negative first half of the year. And yet, frankly, markets have continued to climb a wall of worry. And I think it's really important to appreciate that we as humans are wired to focus more on the negative stuff. I was reading a book called The Psychology of Money recently, which many of you may have read, that actually really stressed this point. It's part of our survival instinct that when people tell you good stuff, you tend to dismiss them as kooks and idiots. But when people tell you the world's coming to an end, you pay attention. Whether that is necessarily a correct reflection of what lies ahead is another matter entirely. But certainly, I think it's our human nature to want to look at the worst case scenario of what happens in investment markets. Doesn't necessarily mean that's what's going to play out. Still sticking with our live in the sun, invest in the shade mantra. I think taking you through our thoughts on SA equities hopefully explains that. Just, how we come out of this, we certainly expanded our investment toolbox. We are making greater use of fixed income in clients' portfolios to remove some of the volatility. Instead of populating portfolios with some of these more volatile shares, we now have this next generation exchange traded note, which is where we now invest in some of these new opportunities. In retrospect, we probably launched this a little bit too early, but there's some really exciting companies in there, and I think it enables us to compartmentalize. And where we are at the moment, structured products, I think there are some opportunities there that for the relevant clients we're certainly looking at. So I just want to say in conclusion then, just one or two words on volatility. I think for all of us, last year tested our tolerance for risk. It was painful. There were, in some cases, some clients who found that didn't have the risk appetite that they thought they did. I don't think many of them are with us, actually. So I can say that everyone who's here, thank you. You survived the test. It wasn't pleasant. But I think it explained a lot to us about our own psyche and understanding, what is volatility? Can we handle it? And there's no doubt that, every one of us would love to be in a situation where you're able to get nice inflation-beating returns without too much volatility. So we actually went and had a look out there to see, has anyone been able to achieve this miraculous outcome? And we did find someone, actually. So we found somebody, this investor, I called him legendary investor. He, over a period of 20 years, and this is real returns, delivered an unbelievably consistent performance. There would probably have been a time, between 95 and 2000 when his clients were asking him a few questions. But, over the long term, he did an amazing job. Well, certainly it looked like it. He multiplied investors' money, almost 7 times. He only had 10 negative months out of 218. And the worst of those months was a fall of just over 0.5%. And he delivered a very healthy return. So, on paper, this was an absolutely unbelievable performance. And why can't we all do that? So, if we roll forward the clock, the reason is that this particular investor was Bernie Madoff. And, essentially, very shortly thereafter, he was exposed as a fraud. People lost everything. And those that had been prepared to live with the volatility, it was a tough time in 2008 in the middle of the global financial crisis. But we know subsequently markets recovered. And went on to test new heights. So all I can say is, volatility is something that we need to live with. It's not pleasant, but it's, I guess, part of the price we pay to deliver those inflation-beating returns. And it's important to keep focused on the long term. And that's really my message. I'm sorry, I probably have overrun, but I tend to get very excited when I start talking about equities. So,
Okay, what am I pressing?
you can just pick up
What this?
or
Where am I clicking?
slow or the clicker.
Which clicker on the side? Okay. Okay, my turn. So thank you very much, Michael. That was very interesting. I hope you all found it fascinating. Can you hear me at the back? Okay. Right. So complete shift. We're not talking about investments now. We're talking about Anchor RCI and all of you. So here we go. What I'm going to do first is show you what I'm going to talk about. I can't actually see much on my screen here, but hopefully I won't have the same issue Michael did and you'll be able to read what you see. So first of all, a brief history, and I'll explain what that's about when we get to the slide. RCI and you, staff, and then succession plan. So let's get going. On the brief history, what I've done to show you, I'm going to take this out. I hope you can all see me still, those of you who are watching on the screen, but I'm going to turn towards the slide on the screen here. So what I've done is gone back to when RCI started, and Robert was basically the only one here, 1982. And the only thing the South African institutions could invest in were local assets. We were not allowed to invest offshore. And I don't know whether any of you remember the financial rand and the normal rand and how that affected what you send out the country, etc. It was quite hectic. And there are a lot of you here who won't even know what that means. In 1990, we had the release of Mandela and the Rainbow Nation. And that's when I joined Rob, and you can see the growth in assets there was up to 200 million. So we're doing well in 8 years. After Mandela, we had the Rainbow Nation, the democracy started. And one of the things that did come in was the relaxation of exchange controls, 1997. And we were allowed to invest offshore. And it was a whole manual process of going to the receiver and going to the bank and taking all of you to the bank to sign to make sure we could get you 250,000 offshore. And that then increased to 500, 750,000 and now 10 million. But that had a significant impact on our investing for all of you. And that's what I'm trying to show you is there are global events that affect what we do and will continue to do going into the future. So we were then allowed to send asset stock offshore, and suddenly there was a whole universe that opened up to us. Rob and I used to hot-foot it off to London quite regularly to go and talk to fund managers, and it was a very exciting time. Excuse me. In addition to that, in 2001, in rollicked capital gains tax, which we had never had to worry about before. And then again, can somebody get me some water, please? Thank you very much. That had an impact on how we invest, because now we had to worry about what capital gains tax we were making on doing any trading or selling for all of you. So that's when we started unit trusts, because with unit trusts, you don't have the problem of capital gains tax until you sell. So all the time you're working out ways to make sure that your assets are doing the best that they possibly can. And that was certainly the beginning of a new era and has become more and more important in all our lives as the years have gone by. So after that, we then had the rise of social media. That was a very interesting time. And that's when Alan joined and our assets were sitting at 600 million. We then go on to the big global financial crisis, which was terrifying at the time it happened. I'm not sure it was as terrifying as this last year because we had the rand that protected us to a large extent. But you can see there in 2008, and talking about Michael and volatility, thanks very much. Our assets dropped from 1.5 billion to 1.2 billion. I'm going to leave it here for a sec. Once you put it down. So then what happened? We then had the very exciting swearing in of Jacob Zuma as our president. And if you remember rightly, most of us were saying, well, we won't be here. If he comes in, we're all going. And here we still are. So obviously it's not that bad. But what did happen, our decision was to start sending more of client funds offshore. Then another curveball that has made a huge difference to our lives and to your lives, and Andrew will talk more about it just now. CRS legislation and FATCA came in. What that is basically the global jurisdictions decided it was time to share all information. So all these jurisdictions that were considered to be tax havens then signed this legislation, Common Reporting Standards, and from there developed all the compliance that you are now subject to. And it's become a bigger and bigger focus because everybody wants to know that you're not being baddies, basically, and you're not doing money laundering, and we're all caught up in that net, and it's becoming more and more onerous. Then, 2015, we had the famous firing of our Minister of Finance and the effect that that had on our rand, etc. It was quite a big event in all our lives. In that year, Rob retired and Anchor became our majority shareholder and are now the only shareholder. They own RCI 100%. And assets at that point were 3.8 billion. And by that time, we were only 33% offshore and 67% local. And that's not that long ago. That's 8 years ago. And then just as an example, we had Brexit. So what does that mean? That means that we stopped investing and avoided the UK as an investment destination. And we have very, very little exposure to UK shares, if any at the moment, I think. RCI, none. So that's the kind of impact that these events have on us. And then we had Cyril Ramaphosa sworn in, and hooray, we were all going to be rescued in 2018. I think that was the assumption that all of us made. Al retired in that year, and Mike Gresty joined. And our assets by then had grown to 4 billion from 3.8 billion when Anchor bought us. Now, these figures that I'm quoting here are subject to all of you bringing money in and taking money out of the market movements, etc., etc. So they're not actually a reflection of growth, they're just a reflection of what happened at RCI. Then we had the COVID disaster, pandemic, and all our reactions to that. It was one of our best years ever in terms of performance for all of you. And the assets grew from 3.9 billion to 4.2 billion in the space of a year. So when you get that kind of growth, I think one has to expect that maybe there's a bit of a curveball on the horizon. They reached their peak in December and grew to nearly 6 billion. But look at that, locals 26% and offshore was 74%. And during 2022, when Mike's already explained everything that happened, I kept on saying to clients, I know the South African market's doing well, but I cannot, I'm sorry, there's a bit of a popping noise here. I cannot, in all sincerity, bring money back here for you under the current South African environment. And we must stick to our guns and we must do what we said we were going to do. And we're going to live in the sun and we're going to invest in the shade. And Al and I started doing that. It was in 2015, and it's never really been any different. And I don't see any reason now for that to change. So that is how we will continue. In 2022, Andrew was promoted as a director. Promoted is the right word, he became a director. And we started Anchor Succession, which Andrew is going to talk more about, and assets declined to below 5 billion. So that was the effect in terms of money as opposed to percentages. And where are we now? Well, global markets look like they're starting to recover. I'm not going to elaborate on what Mike's just said. The assets have grown back to over 5 billion, they're now 5.2 billion. Locals 27%, offshore 73%. And that, if anything, will become more, not less. We do have to keep a certain percentage here because some of you have benefits and pension of retirement products, and we have to have a percentage in South African markets. So that's just to give you a bit of history as to what happens globally has a huge effect on what we're doing for you. But more importantly, what about all of you? So we started with a handful of clients and we now look after 200 families. We call you high net worth clients, and you are, some of you, we are looking after the 4th generation of people who originally started out with RCI. The size of the portfolios vary, as you can see, from 1 million to 500 million. I'm reading it in case any of you can't see it back. And we've expanded our offering because as you've all grown up and grown older, there are new generations that have come along. So many of them have left the country. And so we've had to, and we've been able to invest offshore and structures have become more complicated. So we now very much offer family office services to all of you so that we can look after you holistically and not only after your investments. So we work with a set of highly skilled specialists. All of, I think, them are here. So we know enough to know when we don't know enough. And we then think it's very important to call in those people who can be a better benefit to you. So I'll go to my notes now. Okay, so where are the gaps? We think a lot of the gaps that we have on our side, considering our backgrounds, is on the legal side and on specialized tax matters. And so what we've done is we found people who can help us do all of that for you. And we work with them, and Andrew will go into more detail later on. The first name you see there is Louis Fenter. Louis Fenter heads up wealth succession and is a fiduciary and estate planning specialist. All these people have got degrees this long, but I'm not going to read them all out. But they are all very highly qualified and have done a lot of studying behind what they do now. He's the founder of Wealth Succession, and we formed a joint venture with them. And as I said, Andrew will go into more detail. Sine Schwim has an LLB. Oh dear. How do I get down here on my notes? What? And so he has an experience in the financial services. Thank you. See, I'm technologically challenged. Luckily, we've got young school. She's wound up many estates for us and continues to do so. So at any point in time, Sine is doing a huge amount of work for us on looking after those loved ones of yours that have passed on, including my parents. So she comes highly recommended. Michael McKinnon is also here. He specializes in cross-border tax, exchange control, and corporate advisory. He does all our immigrations. And please, if you've got children who have gone, or you're thinking of going and you haven't immigrated, you need Michael. He does SARB approvals, he does all our VDPs and regularizations with the Reserve Bank. A lot of people don't realize the Reserve Bank's an issue. It is an issue in most of our lives. He's a registered tax practitioner and has many contacts in the industry. Over the years, he's been involved. Worksmans is a name you all know. When we need legal opinions written, and there are some of you who have very complicated lives, very complicated structures, that's who we refer to. And we have Ransom Reserve, who do a lot of your tax. and are very involved in our lives and making sure that your tax returns are submitted. And they're also here today. Looking at one of them now, his name's Gresty. And then we have Andrew Lawson, who's not on my list. And Andrew Lawson comes up with amazing ideas on how to structure businesses, corporate advisory, and has really pointed some of our clients in the most amazing direction to cope with offshore, onshore, where companies are, etc., etc. So that's just to give you a flavor of what we don't know, but we are becoming experts at as we talk to all these people. But we really need their help to help you. So I wanted to point that out. And then there's us. So this is our team now, and there are new names at the bottom down there, and you've got some very young pictures of all of us, which were probably taken. Brendan, you would know when they were taken. It was many, many years ago when we decided to all have photos for Anchor. So there we all are. And you can see I haven't got a name. I haven't got a title. So that's me. I'm actually the CEO, which is Chief Executive Officer. All that means is that I run the business and boss everybody up. And we've got Mike, who's our Chief Investment Officer. And I must say, he's done a wonderful job over the last 5 years, having taken over from Alan and continued on his way and kept us all on the straight and narrow. Then we've got Ogs, who is now one of our directors. I'm going to say a bit more about it just now. We've got Eric, and you can see they've got their professional qualifications next to them. Eric, who's one of our fund managers, been with us for many years, Ross as well, and Kirsty, our CA, who also keeps us on the straight and narrow from an accounting point of view. Then we've got all our staff at the bottom. I'm not going to read out their names, but we certainly value what they do for us. And I'm sure all of you have something to do with some of them. And on the right, because we're part of the Anchor Group, we just wanted to put into context that we have access to much more resources than we just have at RCI. And for us, that's been the huge benefit of being with Anchor. And our investment process in particular is very integrated. And it's been very, very useful to have all their input on that side. So here we go. Succession planning. So what's going to happen from here on? So you have me, and I'm not going anywhere. I still intend to be the CEO for a while. I'll let you all know when it's not a good idea, or everybody else will let me know when they think it's not a good idea. But I think some of them are a bit terrified to say anything. So just that's me. But I am now 66, and I don't think that I should be running a business by the time I'm 70. And I want to read something to you that Ross sent me yesterday. And what Ross said to me was, this is what you've always said to us and what we've done. It's called Nuggets of Wisdom. It's a quote. Oh, God, it's gone now. It's a quote from Chairman Stanley Druckenmiller. I can't say the name, Duquesne Capital. And the heading is Hire Younger Folks. I've had a lot of losses over the years. I got scars all over. I'm not as good as an investor as I was in my 30s and 40s. I can predict better, but I don't pull the trigger the way I did when I was young. I only hire people in their 20s. Once you get the scars, it wears on you. So the humility is well earned. But yes, you've got to have humility. And I think it's one of the things that I've learned is every time you think you're being very smart, something comes along and smacks you and just shows that you're not as smart as you thought you were. And we very much work by that mantra that, be as humble as you possibly can. But having said that, I've also learned that you have to employ people that are smarter than you. And I think that's a very, I hope that I've done that. I think I've done that. This team that we've got are very smart. Well, I think they are. I hope you do too. And it's very important not to employ people who are just going to say yes. So I get quite a lot of flack, but that's very important to keep the business on track. Then we've got Michael, who, as you can see, is our Chief Investment Officer, and he's been wonderful, added a huge contribution both to RCI and to Anchor, and is very highly respected by everybody. And then we have Andrew Lawson, who's been with us now for 7 years, 7, 8 years, made a huge contribution, and we are promoting him to Managing Director. He is a succession plan. In years to come, he will be the CEO, and we're very grateful to have him. He stepped up to the plate. He does an excellent job on all the operations, and as time goes by, he'll be the one standing up here saying all these things to you and will lead the company forward. I'm not going anywhere, and my love is being involved with all of you. And that's what I really want to continue doing, because you're the lifeblood of the company, and it's what I really love being involved with. So that's just to give you a flavor of where we're going, and hope that gives you some feeling of what's happening at RCI. Having said that, I'm not going to have I talked too long. Nobody's told me to shut up yet. Far too long. I'm sorry. It's Og's turn now. Way too long.
Thank you, Di, for the intro. And Mike whispered in my ear, he didn't know that I'd already told someone else, but our 45 minutes was 10 minutes ago, so my time is -3 minutes. So thank you for coming. I'm going to run through things very quickly on my side. It's really more of a little, I suppose, we'd call it setting people's expectations for the future and what's coming everybody's way, and maybe just a little bit of background in terms of what we've been doing to get to where we are at the moment. The first thing that Di did speak about was anchor succession. We'll just run you through what that all means, and just to give you a bit of a heads up that when you start seeing the name, so you have some understanding about what it is. And then just a quick update on, obviously, the grey listing, which has been a very topical scenario, both at Zafka and in general and in the investment world, and what the sort of impact that we are already seeing on clients and investments and structures and compliance, how that all fits together. So Anchor Succession was a JV that has been set up between ourselves and Wealth Succession, headed by Louis Fento, who Di introduced earlier. This is very much a scenario of we know enough when we don't know enough, and this is really to bring in a real sort of a proper legal aspect to services and offerings that we can provide clients. Obviously, succession being the key word, and really it revolves around estate planning, would be the sort of high level sort of scenario. What does estate planning entail? Really, it's about wills, estates, and your investments. Your investments tend to fit into, and this is really stolen directly from Louis, his 4 silos approach. So assets either sit in trusts which do not form part of your estates, but require special legal advice on. They're either owned in your own name, in which case they do form part of an estate. That comes with all sorts of complications and taxes down the line. Things could be held in companies, shareholders of companies could be trusts or yourselves, and then you have your sort of pension assets, we'll call them. So your living annuities and retirement annuities. what does anchor succession allow us to do from a really focusing on a trusts and estate side of things is that there has been recent legislation that has been introduced. Many of you may or may not have seen it. There were obviously, you see all the panicky headlines in Daily Maverick about the increasing legislative requirements and compliance and regulatory issues that trustees themselves are now personally liable for complying with. So from a trust point of view, historically, you may have had your brother, sister, husband, wife, son, daughter as trustees on your trust. Over time, you have probably appointed a die. John? No.
Oh, no, thank you.
No.
Yeah.
No. We'll have to do it without that.
Shout.
But what has really sort of evolved from a trustee point of view is that it almost is, if you don't have the actual legal background to understand the legal implications of doing things, is that you probably open yourself up to quite a lot of risk. So from a trustee point of view, DIE sits as trustee on about 80 local trusts. To give you some idea, that requires a huge amount of oversight and knowledge and relationships with all of you that have been developed over the years. But as the legal requirements change, so we are sort of almost being forced into a position where you really require what I would call a professional independent trustee, not just an independent trustee. And that really comes back to the scenario of having proper legal minds involved in these scenarios. And it's really from a compliance and an oversight perspective. Nothing against that at all. It's not a quick process to change anything. So this is really just something to look forward to in the future if you do have a trust. Maybe looking very far into the future, given these kind of legislative requirements, you may well find that you end up in a scenario similar to offshore trusts, where you actually don't want to be a trustee of your own trust, and you purely have an independent corporate trustee who runs things for you, just purely because of the risks of being a trustee. The penalties that have been imposed or that have been legislated now at the moment purely for non-identification of ultimate beneficial owners, so keeping ID documents of everybody that's involved in a trust, is 10 million rand individually and all 5 years in jail. So the penalties are not immaterial. And so there is really a requirement to take this quite seriously. It is unfortunately, and this is, I suppose, the expectation setting side of things, is these things don't come without costs either. And I'll talk a little bit about the grey listing and the implications of that. But all of these compliance scenarios add to costs, not just to our costs, but to your costs as well. And a lot of it is unavoidable. Something just to sort of prepare in the back of your mind, that there are likely to be additional costs involved in various structures. Doesn't mean that we don't like trusts from an investment point of view. Absolutely not. They still play a vital role in estate planning, asset protection, tax planning, etc., etc. So that's really on the trust side of things. Just on the grey listing, so obviously, Di referred earlier to FATCA. So the Financial Action Task Force is the sort of regulatory body that oversees these things. Puts that on a grey list. What does it mean? It means we've been in the naughty corner from a compliance point of view. I think that the impact for us as investors and for investment managers and advisors is it's material, and it's quite frustrating, because I think if you go into the detail of why we were grey listed, I think it's quite straightforward that there's been very little very little repercussions for things like the Guptas and any financial crimes that have really not been prosecuted in South Africa. And we sort of bear the brunt of the implications from a global perspective from those failings. There were initially lots of headlines from Cyril Ramaphosa about calling this an opportunity. I know we've sort of stolen this from the Worksman's guys, but it's definitely not an opportunity. You don't want to go to the naughty corner to think that you're climbing the podium. And it really does highlight the failings of government. Is this a quick process to come off the grey list? No, it can be sort of about a year or 2 year long process, but it really depends on the implementation of government doing things and showing that they are actually committed to doing things. Is that likely to happen? We can have that debate for weeks. What does being on the grey list mean from a practical point of view? Is that it really means that there are significantly increased KYC and AML, so know your customer, and anti-money laundering requirements, both locally, but offshore really in particular, is where we're seeing the actual impact. So expect to be asked for FICA documents all the time is the short answer. Don't ever not have that kind of information available. Don't be surprised if offshore bank accounts get frozen, if investment accounts are not accessible because we needed beneficiaries' updated proof of residence. These are real impacts that we are already seeing from an investment point of view. One of the big things is being able to provide actual evidence of where your money came from and how you made your money. And that can literally go down to the detail of your pay slips from the last 5 years or 10 years. Employment contracts, company accounts, if you have company investments in private companies, details of inheritances that you may have inherited 20, 30, 40 years ago. It's often documentation that people don't have. So if you do have access to it, it's worth keeping a little file together of all and as much information about as much as possible in terms of anything financial that you've done. So yeah, like I said, please expect. So we, from an RCI point of view, as Dimension being part of Anchor, we have access to a much broader resource from a staffing perspective. And so they have an entire compliance team. We have Marika, who's sort of responsible on our side, and Christine. They've got an entire team of people doing FICA. Please expect constant requests for stuff. If you see it coming from, it will always come from RCI, but there may be Anchor people involved. It's purely just a function of what we are going to be forced to do. At a minimum, you will be required to update FICA every 3 years. That is at a very, very, very minimum if there is very, very, very low risk from you as an investor. Unlikely that would ever be the case. Be expected to be asked for it at least 2 or 3 times a year, would be my guess. What does it mean? There's additional time, there's additional cost, and there's additional frustration for everybody. We don't enjoy doing it. We don't enjoy asking you for it, and we do really understand your frustration in terms of having to provide all the documentation. Just to give you some sort of ideas as to what we've been seeing. So to set up an offshore trust at the moment literally can take up to a year. We set one up last year. We were waiting for Reserve Bank approval for a transaction, which we got. And the offshore corporate trustees turned around when we eventually got the Reserve Bank approval. Process had taken a year. They turned around and said, cool, we need to open a bank account. That'll be a 6-month process minimum, just to get a bank account open for the entity that has already been established offshore, with corporate trustees as the guys running it. Because everybody is looking back and looking through. So anybody named in a trustee, who's the settler, who the beneficiaries, who the funders of the trust. All of that kind of information is being asked for, and lots of detail about it is being asked for. including things like a CV. May I ask you for a detailed CV about where did your money come from? So what do we do about it, and how do we try and tackle this? It's a bit of an unsolvable scenario in that, as is sort of the nature of what we do, is that we have a whole series of different providers. So we would have a stockbroker for your local share portfolio. We'd have a stockbroker for your offshore share portfolio. We have a unit trust administrator for unit trusts. The list goes on and on. Your Allen Grays, your Coronations, your 91s who provide retirement products. Each and every one of those institutions is going to have their own rules about what they expect from a FICA and a compliance point of view. And that is often out of anybody's control in terms of what other product providers want. And we really have no choice but to comply and provide them with the data or the documentation they require. In order to try and simplify things from that perspective, we will, where possible, try and consolidate investments. So if we can move your unit trusts and your share portfolios onto a single platform, that is something that we will very likely try and do over the next year or two. Purely from a compliance point of view, it'll make everybody's lives much easier if you're only having to provide all the documents to one provider and not 3 or 4. Those kind of things do unfortunately often come with additional costs. That costs tend to be minimal, and would definitely be worth it purely from an ease of doing business perspective, both for yourselves and for us. The alternative is that we employ more staff on our side and send you a fee increase later, which is not what you want either. That's really it from me. I think we're about an hour past where we're supposed to be. So yeah, thank you all for coming. It's lovely to see many of you. It has been a long time since we've had a get together like this, so lovely to have everybody here.